Greetings, everyone. My name is Lily O'Brien. Thank you for giving our team the opportunity to present our analysis and strategy for financing Panera's future growth. Let me start with introducing our team. I am Lily O'Brien. We also have Dylan Tackett, Luke Ziegler, and Daniel Dosey. I also want to take a few minutes to walk you through our agenda. We will first provide an overview of Panera Bread Company to set the context with some history and background. Next, we will look at the challenge that the business was facing at the end of 2006 with regard to charting a path for its future growth, as well as sharing the problem statement for Panera Bread Company. We will then move into the major agenda item where we will look through our multi-period forecasting analysis, Panera's 5-year forecast, and what we recommend as a strategy for Panera to finance the growth charted on this multi-period forecast. I will start with some historical information on Panera to set the context first. So Panera started as St. Louis Bread Company, which was owned by Al Payne in Illinois. Then Panera grew into Panera Bread Company over the years. With that said, Panera has been enjoying both strong margins and rapid growth due to its successful brand and business model until the end of 2006. The strong margins had allowed Panera to finance its rapid growth primarily through its retained earnings. Another financing source, which was minor, was the equity infusions from compensation programs. Panera did not use permanent debt financing to fund its growth until 2006. Panera's historical success can be easily demonstrated with these factual statements. From 20 to 1,000 locations in a 10-year period, 1993 to 2003. And then from 2003 to 2006, Panera had a 32% annual revenue growth on average, as well as a 12% operating profit to sales average. I will now hand it over to Dylan to provide you with an overview of recent challenges and the business problem.
Thank you, Lily. So in terms of the recent challenges that Panera was facing, I'd like to start with a couple important contextual elements, and that's just regarding the market itself and also business growth challenges that companies like this face in general. So with the quick service restaurant market, it's highly competitive and there's generally relatively low margins. And so one of the main challenges to growing the business is usually cash flow. And as Lily shared, so with Panera's history and their success with growth, and also just having strong margins at the start, they ended up facing a couple challenges near the end of 2006, beginning of 2007. They faced a decline in margins, primarily due to rise in commodity costs, particularly wheat, which is in most of their products. And in addition, they had started seeing costs just start to grow and be a concern for the entire restaurant industry, including themselves. And as a result, there were declining margins and cost uncertainties for them. They had limitations in ability to rely on their internal funds as they had done in the past, such as retained earning to support the growth trajectory. And along with these challenges, such as tightening the margins and uncertain costs, as well as just softening transaction growth in 2007, this had further caused Panera's stock price to drop significantly by about 10%. And then after the announcement in their quarterly earnings, it went down another 40% over the previous year. And so a little bit more about the problem. So we needed to solve this issue for Panera with their tightening margins and what they needed to do. And so with their expected value and growth, we need to create a plan for capturing more market share and rewarding shareholders with well-placed and financed growth. The challenges that we discussed, together with the $75 million stock repurchase under consideration, it drove a realization that internal financing would not be sufficient to continue business with this company. Accepting tighter margins would allow for growth, but that's a problem because it would also limit the ability of internally generated funds to finance this growth. In the end, it's pretty clear that Panera would have to consider for the first time accessing these external capital markets, both in the short run and the long run. As we said earlier, the company obviously had not preferred debt financing for growth purposes in the past, but we feel as though it's necessary now that they have faced this problem. To summarize and narrow further down the problem that they're facing, we needed to answer what type of financing should they take out, at what level, and when. To answer this, Luke is going to start with our analysis of the 5-year income statement forecast.
Thank you, Dylan. So before going into the income statement forecast, it's important that we first provide a list of assumptions used to build this forecast. So listed here, as you can see, is a list of our assumptions. And while most of these assumptions are stated as an average of the past percentage of sales, a few of the assumptions are much more complex, such as the G&A expenses, which are decreasing year over year as we capture our economies of scale. So moving on to the next slide. As we use the historical data as well as the assumptions for the next 5 years as input, we're going to look at our forecasted income statement. So when analyzing our forecasted income statement, it's important to note that we find growing in the company, in turn accepting tighter margins and creating a need for external financing to be the most viable option rather than raising prices. So as you can see, in 2007 and 2008, the margin compression really takes a hit on us as we start to see a decline in net income despite growing sales. This is in part due to our financing strategy, which we'll discuss a little bit later, but this only makes up for a small portion of the decline in net income. So moving on to 2009 and 2010, for the operating margin, we can see that it starts to increase, even though in comparison to our 2003 to 2006 margins, we're still much lower. Not where we want to be. And then for the net profit margin, it decreases to its lowest rate in 2009 and 2010. And this is because of the higher interest expenses, but that's the lowest that it gets. The silver lining in this is that although net profit margins decreased farther, our overall net income has exceeded the 2006 level, showing that our growth strategy has started to bear fruit. So in other words, 2009 and 2010 demonstrate that the margin compression trend is coming to an end. So then as we move on to 2011, 2012, this is where we really start to see the benefit of our long-term plan. So as it can be seen, both our operating and net profit margins start to increase, showing that we're starting to move away from the times of market compression. And even though our margins are still below our 2003 to 2006 levels, it's good to see our margins start to move in a positive direction. In addition, our net income indicates substantial growth of about 34% from 2006 to 2012. And this demonstrates once again how our growth strategy is really working. And we're starting to see a much higher net income, even though our margins are lower. Now Daniel is going to walk you through the balance sheet as well as the financing strategy given our forecasted income statement and Panera's problem at large.
Thank you, Luke. Your analysis of the income statement gives us a clear view of the revenue growth as well as the net profits that feed into retained earnings. I will now utilize the results of the income statement forecast and analysis to build and analyze the balance sheets through 2012, which basically tells us that we need external financing through debt because retained earnings are not sufficient and we assume no equity financing. Historically, during 2003 to 2006, as Luke showed us, our margins stayed relatively high, and this enabled Panera to cover all of its cash needs, including for growth purposes. And this was through retained earnings and some small equity infusions. But as we approached 2007, our margins started to face high levels of margin compression, along with high levels of sales growth and a decreasing stock price, making it so that our retained earnings could no longer cover our cash needs. In addition, as stated earlier, we are assuming that Panera will not take on equity financing. So what is Panera's best financing option? Given the balance sheet analysis I just walked you through, Panera needs to take on debt, but the next set of questions of how much, what type, and when was still at hand. So we adopted a conservative long-term debt strategy. By this, we mean incrementally borrowing only the amount that is needed to finance our current year of operations. 2007 is the first year where our retained earnings are not enough to cover our cash needs and operations. For 2007, we recommend taking out $61 million of long-term debt in order to fund cash needs and operations. In 2008, we need to increase our outstanding debt substantially to a level of about 202 million. This is due to a stock repurchase equal to 75 million in 2008, along with substantial sales growth without the margins to support it. 2009 is the last year that we increase our outstanding debt levels to about 301 million. By doing this, we are able to fund operations and cash needs for 2009 and the future. Additionally, we start earning enough to pay our debt off during the following years while still being able to fund cash needs and operations. When we expand our forecast beyond 2012 with basic assumptions, we find out that all debt gets paid off around mid-2019 with this strategy. So just to kind of reiterate why we chose a long-term debt strategy, it really allows us to spread out our debt payments while at the same time having predictability with payments and accuracy with our forecast. In addition, this kind of debt strategy will make it so that we get the benefit of an interest tax shield for quite a few years in the future. Now I would like to hand it over to Luke so that he can share with us the pros and cons of debt financing, but also equity financing and our conclusion.
Thank you, Daniel. Although we assumed that Panera would not take any equity financing, it is important to look at some of the pros and cons, as Daniel mentioned, of debt versus equity financing. So first, we'll start with debt financing, which is the situation we presented for Panera. So the pros of debt financing include it being non-dilutive, which is important to us considering the falling stock price as well as margins. Predictability is another big pro of debt financing, as we're creating a long-term forecast. And any unpredictability within a company is not very good for us. And then a last big pro to debt financing is the interest tax shield created, which in turn increases earnings per share. And then some of the cons of debt financing include consistent principal and interest payments, adding to our cash flow risks, and barriers to entry, including collateral and credit rating. So now with regard to equity financing, some of the pros of equity financing typically include no required repayment, no interest fees, and typically more capital. Some of the cons of equity financing include dilution of control and existing stocks, as well as more potential owners, leading to slower decision making. Next, I'll pass it to Lily.
Thank you, Luke. So our team decided that a conservative debt strategy is what we designed to address Panera's challenges and help it achieve its growth objectives. This debt strategy is successful in achieving the objectives of the funding Panera's growth, margin compression, which was slowed down and then started reverting, the stock price increases through retained earnings. Thank you so much for your time, and now we would like to open up for questions and answers.